10-year Treasury futures begin the week in a very tight trading range with the plethora of data and information coming out later in the week. It seems like futures are content to stay still. What's causing futures to hold up, as it were? We've heard some dovish comments from the ECB with regard to purchases, and they must preserve accommodation well into the recovery. That was perceived as dovish. Also, some lackluster German IFO business survey numbers came out, missed expectations. On our shores, we had the U.S. capital goods, which really failed miserably according to consensus, and a lot of traders look to that number as a proxy to capital spending. Also, it's worth mentioning, 10-year break-even inflation expectations down ever so slightly. These are all seem to be helping to hold up the futures prices. On the other side, there is some bullishness that seems to be at odds with the market right now. First of all, supply pressures. We have $200 billion in auctions this week, $60 billion of a 2-year today, which was the results were uninspiring to say the least. We also had a $61 billion 5-year auction, which did come out fair. We did see knee-jerk reaction from 10-year treasuries after both of those auctions, but nothing really to speak of. With regards to option volatility and option volume, looking at the whole curve in June, according to the CME CVOL, 1 month and 3 month are little change. We have the 1 month at 10th percentile. We have the 3 month at a 50th percentile in terms of relative cheapness to the last year. Looking at down variance and up variance, both of them are flat on the day. That would imply that at the money implied skew is also flat on the day. June at the money volatility down ever so slightly. When it comes to volume, looking at June options, the 131 put seems to have the most volume today, followed by the June 132 put, also seeing volume in the June 133 call.